Ladies and gentlemen, the Federal Reserve has just shocked the world and shocked the markets. Everybody thought the Federal Reserve was going to come out and say that we've paused, we're done lifting interest rates, and they're going to forecast that they'll be cutting interest rates later this year. Well, guess what? The absolute opposite has come out, and this is a huge game changer for the macroeconomic picture and for the stock market rally. So what exactly new information do we get from the Federal Reserve that changes everything? Well, that's exactly what I'm going to cover in today's video, everyone. So let's not waste any time. Let's get straight into the news, the facts, and the data. Well, look at this, everyone. Powell says nearly all officials expect some further Fed rate hikes. And policymakers actually lifted their medium rate forecast to 5.6% at the end of 2023. So this is huge, everyone. Even though they're pausing now, they're actually saying there's going to be another 2 rate hikes by the end of the year, when a lot of the stock bulls were saying they're going to be cutting interest rates by the end of the year. Because we got the CPI report yesterday and it showed that headline CPI was falling to 4.1%. But what a lot of people don't realize is core inflation, which the Federal Reserve watches a lot closer, that is actually still rising and it's actually at 5.3%, which is 2.5 times the Federal Reserve's mandate. Because what is the Federal Reserve's job? Well, it's very simple, everyone. Price stability and full employment. Well, right now, they've got full employment, but they still don't have price stability. So it should be very simple. They should have actually lifted at this Federal Reserve meeting and kept lifting until they got price stability. And then if the economy falls into a very bad recession, well, then they can just simply cut rates. But okay, let's get deeper into this report. So holding the target range steady at this meeting allows the committee to assess additional information and its implication for monetary policy. And we can see here on the Fed's dot plot, everyone, that's where they expect interest rates to be. So we can see here at the end of 2023, they expect it to be around 5.6%. The FOMC vote was unanimous. Of the 18 policymakers, 12 penciled in rates at or above the medium range of 5.5% to 5.75%, showing most policymakers agree further tightening is needed to contain price pressures. The forecasts imply officials expect 2 additional quarter-point rate hikes or 1/2 point increase before the end of the year. Now, we're seeing how this has worked out with other central banks, everyone. For example, Australia's central bank and Canada's central bank, they both did a pause and then inflation accelerated and now they're starting to hike again. And I think the Federal Reserve is going to make the same mistake. Jerome Powell said nearly all Fed officials expect it will be appropriate to raise rates somewhat further in 2023 to bring down inflation. He declined to say whether another hike could come as soon as July, but emphasized that it would be a live meeting. Now, just very quickly, if you're wanting to learn how to build wealth and protect yourself against a downturn that will be coming or a potential market melt up, you click the link in the description on my course. It's 45% off every single week. As we add new content to the course, the price goes up. So get in now before the next price increase. Because listen to this next statement, everybody. Inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. That's exactly right, everyone. A lot of the stock market bulls are declaring victory over inflation, but we're not even close to getting there yet. Core inflation is still very sticky and is still running at 5.3%, more than double the Federal Reserve's mandate. And the only reason why the headline CPI report has been falling is because of volatile energy. And we all knew the stock bulls would say, oh, look, it's volatile energy. That's the reason why inflation's high. Once that goes, then, we won't have to worry about inflation. But if we get another tick up in energy prices, well, that's going to make inflation surge again. We've covered a lot of ground and the full effects of the tightening have yet to be felt, the Fed chief said. That's another thing a lot of people are not factoring in. We haven't felt the full effect of all these rate hikes because they've been risen so quickly. And normally there's a lag of at least 6 months from when interest rates hit their peak, not from when they start lifting them. So we don't know how bad the economy is really going to get yet. We're going to have to wait another few more months to get more data. The S&P 500 index of stocks declined immediately after the decision. The dollar pair declines against a basket of currencies, and yields on 2-year treasuries surged to the highest since March. And looking at the Dow actually dropped 232 points. But we are at a very pivotal point in the economy and in the markets right now, everyone. It's very unclear how much further the central bankers are going to have to go. Could they have to go to the unthinkable of interest rates of 6 or 7%? Nobody knows. And also, will inflation drop back down to the 2% target by next year? Again, nobody knows. And Bloomberg's reporting there's mixed signals. So consumers in May were less confident about the economy, according to a survey, but their spending picked up in the latest reading. Again, that's just because prices are going up, not because they're spending more people. Powell said the labor market remains very tight. Employees added 339,000 jobs to payroll in May, while job openings remain high. Again, if the job market is so strong like they say, why are they pausing? Powell said he and his colleagues still think inflation risks are tilted to the upside, though he said the risks of doing too little or too much are getting closer to being in balance. But guess what he said next? He suggested rate cuts are probably a couple years out once inflation comes down significantly. So this is an absolute huge statement, everyone, because a lot of the stock bulls are betting that there's going to be rate cuts this year or early next year. Well, the Federal Reserve is saying there's not going to be any rate cuts for at least 2 years, because I don't know if people studied history, but when central banks lift interest rates, they don't go from lifting interest rates to all of a sudden cutting the next month. They lift interest rates, leave them there some time for months or years, and only then, once the economy falls into a deep recession, then they start cutting. Because that's what it's going to take, people. Once we enter a real official recession, that's the only way inflation is going to come down, and we may actually get deflation. Okay, now let's get into the economic projections for the rest of the year. So for 2023, the median estimate for gross domestic product was marked up to 1% from 0.4% in March. So wow, 1% growth, people. Again, when you factor in inflation, we are having negative growth. Unemployment is forecast to average 4.1% in the fourth quarter, compared with 4.5% projected in March. An official jobless rate stood at 3.7% in May. Now, the PCE inflation rate was expected to be 3.2% this year, down from 3.3% projected in March, but core inflation projections increased. So everyone, unlike a lot of people were expecting, they were expecting Jerome Powell to be very dovish, but we actually got Jerome Powell being very hawkish. That just simply means more aggressive. So make no mistake, everybody, we haven't felt the full pain of all these rate hikes yet, and there's going to be more coming. I think we're in a recession now, but they may change the definition of it, so we may fall into an official recession late this year, and we're going to be facing stagflation ahead. So again, what I'm doing to protect myself against this scenario, because when we study history, every time there's a recession or stagflation, when unemployment rate is low and inflation is high, gold tends to outperform. So I'm continuing to buy that while everybody is running to the stock market. I'm doing the opposite, and that's what you want to do. When everyone's bullish on stocks and selling gold, that's a perfect buying opportunity. And when we enter a real recession and everybody all of a sudden runs to gold as a safe haven and the price skyrockets, well, that's when you want to take your foot off the pedal and wait for the next downturn. But everyone, what do you think about all of this? Let me know down below. Now again, if you wanted to check out that course on how to build wealth and protect yourself against this downturn, link in the description. Thanks for watching. You're awesome. I'll see you all in the next video.